Welcome to another episode of the Wealth Building Strategies Podcast. I'm your host, Jeremy Constantino, and today I'm honored to have on as a guest Wayne Courreges III. Welcome, Wayne.
Hey, thanks for having me.
So, where are you based out of, Wayne?
So I live in Bryan, College Station area, and we primarily focus Austin, San Antonio, Houston, and the Southeast. So we've got properties in Alabama and Louisiana as well. But I'm born and raised Austin, Texas, and moved out to the country here in Bryan.
So, I see on your bio that you got a master's degree, or you went to the University of Oklahoma. Is that correct?
Yeah, so I went to OU, but I went to OU in Okinawa, Japan. I started in the Marine Corps 2003 to 2007 and had the opportunity to further education. And when I lived in Okinawa, I went to the military education office, and they had professors from Norman, Oklahoma too. But I remember asking my dad, even really asking permission, because I bleed orange. Like I am University of Texas through and through. I just didn't do very well in high school too, so I went right in the Marine Corps. One, because there was a lot going on with Operation Iraqi Freedom. I wanted to serve, but two, um, it was a great next step for me to get my life together a little bit.
Yeah, I say that because I graduated from the University of Oklahoma. I went 5 years there in Norman,
Nice.
and I'm also from I grew up in Dallas, so it's strange that two Texas gentlemen
Yeah.
chose to get some upper education in Oklahoma.
It, the first season, because it all goes back to football, right? So the first season, I tried to go for OU, but I just couldn't at the Red River Shootout. So Texas, and my son, we live in Aggie country, and for me, I don't care. My daughters, I would encourage them to go. My son, though, I mean, he bleeds orange. So, and it's not some I can. It's just like out of the womb. He's been a Texas person. So we'll see if that's where he goes.
Yeah, that's good. So about real estate now. So for those of you listening that don't know about Wayne is a managing principal of CREI Partners LLC, based in Austin, and you currently have over $33 million assets under management in Texas, Alabama, Louisiana. And Wayne, you got a lot of experience with Fortune 500 companies. You got a lot of experience in real estate, and so for this episode, um, we talking about let's talk about underwriting, and let's talk about what you do in your business to underwrite properties and ensure that each investment is a solid investment for yourself, for your company, and for investors. So let's open it up and talk about underwriting today.
Yeah, I'd love to. It's an important aspect of what we do on the active investing side for our investors. But I think the first part in underwriting is you got to be very cynical. You got to be wondering, why did the broker send you this deal and not somebody else? And so there's always, and so many of those deals from the brokers, like they've been looked through by many people, and they're just trying, to find someone who obviously can close. So throughout the entire underwriting process, I'm actually trying to convince myself not to buy the property. Okay. And that, initially starts off in certain locations in Texas, primarily Houston. I don't spend any time on a deal if it's in a flood zone. So simple going to the FEMA website, putting in the address, seeing what the flood zone is, that takes care of a lot of deals. And surprisingly, Austin, San Antonio, same way. Like we look at deals that, again, other people have passed on, and then you get a deal, and you see that it's in a flood zone. So that's particular one. So when it comes from brokers, be more cynical. We need brokers. I love brokers. Brokers. We're about to go under contract because of a broker that they brought a deal, but you got to be a little bit more cautious if you're on that side, right? The other thing is if you're on an off market, you have more of the ability. We do a lot of off market searches, and we can talk about that too in this or at a later time. But you know where the location is. It's a little different when on an off market search, because you're targeting and trying to find properties in a certain area. So uh, understanding financial documents, and for your listeners, for underwriting, your typical documents that you start off with are a rent roll. That rent roll is going to show what how many units, the individuals that are renting those units, what's the market rent, what are they actually paying, are there miscellaneous incomes, what's their start lease, what's their end lease date. Then you have the T12. The T12, think of it more like a profit and loss statement or an income statement. The 12 being 12 months of data on the income and expense, and that's broken out in detail. If you looked at from a T3 standpoint, you would have 3 months of data, but we look at it from a 12-month initially. And then we have an underwriting spreadsheet. We have a couple versions that we like to use, and then we'll start underwriting. So I'll pause there and see where you want to go.
That's fantastic. So yeah, keep talking about the tools. So
Yeah.
obviously, everybody that's in investing, we like Excel, and I think Excel is the the tool of choice. But
Yeah.
I guess okay, so let's talk about market rents. So we look at the rent roll, we see what the rents are, and how do you make a decision that, oh wow, these rents are under market, and we can probably raise the rents?
Yeah. So initially, when you're underwriting, time is money. So right, initially you just want to stop underwriting a deal if flags start coming up early, because you're not, there's no need to spend a lot of time if it just doesn't work, right? So one of the benefits we've had, and it just takes time and experience, is we're buying in markets that we know really well. So for an example, we bought a property last year that we're getting $1.55 or higher per square foot in rents. About a mile away, there's a property we're about to put under contract, and I'm underwriting that on year 3. So, year 1 and with growth. So year 3 at $1.40. So from a conservative standpoint, like I'm already getting $1.55 at a property less than a mile away, or about a mile away, but yet my year 3 is at $1.40, right? So when you look at comps, a lot of that is just knowing the submarket.
Yep.
And if you're partnering with somebody in another state that you're not as familiar with, that's okay too, because they know the submarket, right? So you're just like in a team and business. I said this to a friend yesterday. Like, I always want to be the dumbest person in the room. I want to be surrounded by better people than me. I don't have a pride issue. Like, I'm just like, hey, better people, more experienced people are going to help me grow, and they're also going to help the investment be successful. So knowing where it is, but it also is boots on the ground, going property by property. There are resources. CoStar is a resource, and it's a good starting base. You got to pay for that service, but they do have like apartments.com under their umbrella, so they get a lot of good data from that. But there's nothing more, nothing better than actually going to your comp set. And I always like, because I come in, and a lot of times I don't look like I would rent one of these apartments, so I'll come in as like an apartment locator. Like, hey, I'm an apartment locator, and I'm looking. I've got some clients that are looking for apartments. I like to build a relationship, and I come in that way. And it's sort of, in a way, not lying. I'm trying to locate a property. So in my mind, I get away with it, because I did start off with saying, "Oh, I'm looking for an apartment," and it they could see right through me that I'm not looking for an apartment. So. But yeah, you got to look at tools. The other thing too, and not to go all over the place, but there's a lot of free resources to look at, Jeremy. So one of the tools that I like to use is bestplaces.net.
Okay.
So bestplaces.net, if you go in and you put in a city or a zip code, it will, you can see about the population. So in real estate, location. But part of that is there jobs coming in? What's the percentage of renters? What are, what's the population? So I like bestplaces.net for markets that I haven't really researched or learned more about. Or if I'm going in and doing a deal with someone else. For example, we did a deal in Huntsville, Alabama, storage deal with a partner, a fellow race master, a group that we're both part of. And but I had to convince myself of the submarket. So bestplaces.net, for those listening, is a great free resource. You can go in, there's a housing on the left side. You click housing, I believe it is, and you can see what the percentage of renters are. You can see what the vacancy rate. Again, it's a tool. Nothing's going to be 100% accurate. There's also justicemap.org. Yeah, justicemap.org, where you can go in and put the address of the property, and you can actually see not only the demographics, but you can click on income, right? So generally, one of the important things on underwriting for the market rents is, can we get 2.5x or 3x? The salaries or their income needs to be at least 3x or 2.5x of
Right.
monthly rent. So that's another tool too, and it's been very accurate for us. Where if we see, if they're in the light blue, it's like 55,000 income. I'm like, that's pretty good. In some areas, though, it could be 15 to 25,000. So it's like maybe a little bit more concerning if you think you're going to grow rents quite a bit. So we talked a little bit about the rent roll. We talked about the T12. There's some the websites and the resources, but really it's then inputting the data into the spreadsheet. And there's tools, there's Argus and other softwares. But for us, I use a mentor's spreadsheet that's tried and true, and what he's used, and so that's what I use, and we start the underwriting process.
Fantastic. So what are some of your stop points? I guess you said you said earlier you want to put your cynical hat on. You want to be cynical. Why should we not acquire this property? So I guess, what are some of the stop signs, the red lights that say, okay, we need to pass on this one right now?
I'm going to switch it up a little bit, because when I'm in the fact that I get a lot of, so I love to educate investors, and it's not that they have to or feel obligated to invest with me. They actually, they'll come to me and be like, hey, I found this opportunity through another syndicator. What are your thoughts? And one of the things, especially in Texas, every market's going to be a little different, but in certain markets, in Texas, real estate taxes is a big one, right? And so trust is such an important part in the investing process, especially as a passive investor, right? And you get trust through track record of that individual, or maybe referrals, that someone did what they said they were going to do. They were the jockey and the horse that executed the business plan like they said they were going to do, or be a good quarterback on the team. But in underwriting, the scary part is, and it's not trying to scare the audience here, but I can make a deal work. I can make any deal work. Now, is it true? Is it accurate? Maybe not. And when I say that, it's because there's a lot of levers in an underwriting spreadsheet that can be manipulated or changed to make a high IRR, internal rate of return, or a high exit multiple, right? And one of those things is like, I love to sleep, Jeremy. Like I love to sleep, and I don't like to worry. So if I'm having to really make the deal work, and part of that is like the lower the cap rate.
Yeah, exactly.
I can lower the cap rate to help the exit returns, or I can, instead of having 90, 95, or 100% of purchase price as my base for real estate tax, right? So you have your tax rate, and just like in single family and all, it's based on a rate and what the value of the property is, right? So if I'm in Austin, Texas, and I'm doing 85% of the purchase price at the tax rate, like, I'm crazy. Like, but the thing is passive investors don't know that. They assume, Jeremy, that you are doing your job, or I'm doing my job, and I'm going to be conservative in my underwriting. Well, the reality is in Texas, we don't have income taxes. So their big source of revenue is real estate taxes. And so they'll find out. I mean, it's a non-disclosure state on purchase price, but they'll eventually find out about where you're at, or where you need, what you purchased the property for. And it's typically 95% or 100% of the purchase price.
Yep.
So you're already hitting wins if you're underwriting at 85%.
No.
Insurance is another thing. A lot of people are, in Houston, don't want to invest in Houston because of insurance. I'm okay with insurance being where they are. At the end of the day, are you buying at a price where the deal still works, and being conservative, and underwriting and budgeting, insurance rates where they're going to be. You can't control insurance rates, but it's the fourth largest city in the United States. People are moving. It's a diversified economy. So it's just something we have to take into account. And it does sometimes shift prices or cap rates, maybe raises cap rates. So when you ask, what makes me nervous about a deal is when I'm really having to try to make the deal
Yeah.
work.
Yeah.
Um, and then if I'm getting deals from other people and I just sometimes just scratch my head, I'm like, this is just, it's worrisome that, um, some of these people out there are being so aggressive on their underwriting to make a deal work. I always, I put out lower returns for our investors. There's still good returns. A lot of times I'm okay putting an IRR out there 12 to 15%.
Right.
You
Right.
know, and if you're happy with 12 to 15% IRR, or 7%, maybe not year one you don't get 7%, but maybe the year two, because it's a preferred return, it catches up. If you're happy with those returns, you're going to be really happy. If you know we kill it and we're getting much higher teens in returns. Um, but you're also going to be a lot happier during the life cycle, because every month when I send out a distribution or I send out a report, you're going to be happy with me because you know that this was the expectation, or this is where we thought we were going to be, and you're not going to be disappointed. So
Yeah, this is really important for the real estate cycle that we're on right now. It's starting to cool off a little bit, and in the last 3, 4, 5 years, 6 years, um, the underwriters or the projects have maybe gotten lucky, so to speak, because of the accelerated rent growth, in dollar per unit, dollar per square foot, appreciation, and the cap rate compression. So they're seeing the high returns, and they may have missed, um, and underestimated on insurance taxes, but they got a break because the market was so hot these last couple of years.
for sure. And there's a lot of great syndicators. And we probably know several of them mutually. Like, there are people out there that even when times were really, really good, they're still pushing, if their entry cap rate was at 5%, then their exit's close to 6%. There's
Right.
that 1% or more delta on the exit. It's when you're going in at 5% and then your exit 6 years later is at 5.25, or heaven forbid it be less, like a 4.8. It's sort of like, it just, for the listeners, the lower the cap rate, the higher the value of the property is projected. Now, we don't have crystal balls. Like, we don't know what the market's going to be. I'm also not an investor, Jeremy, that's just going to sit on the sideline. There's a lot of people out there
Right.
that just like, hey, I'm just going to wait and see what happens. And for me, real estate, they're not making more dirt. And if you're in an area, as I talked about earlier, with location, with high population, job growth, a landlord friendly state. That's why I like the Southeast, I like this part of the country, because we all need a place to live, right? And I'm not looking for the sexiest class A newest property out there. I'm looking for working class B, in some cases class C properties in great locations, and trying to buy at the best value. But you also, since we're talking about underwriting, Jeremy, like, you've got to underwrite, what we think revenues are going to be, right? How can we, reduce expenses without jeopardizing the quality of the property? Like, I don't want to be a slumlord. Like, I want to truly increase the happiness of the community. One of our projects, we put in a playground, we redid the pool, resurfaced, and opened the pool back up, and then doing a gazebo with a grill area. Over 50% of those units, like pretty much the whole second floor, had water leaks because of just the original roof. So we went in and recoated the entire roofs. HVACs were an issue. Like, we put in millions of dollars into our properties. Um, and that's part of this underwriting process too. When you underwrite, you've got to do a really good due diligence. And, part of the due diligence is having people smarter and better than you go to the property during due diligence time and inspect. And then when you inspect, you get a good budget plan of things that you need to know, and that goes into your underwriting, right? So that kills deals too, because sometimes you budget 1.5 million for renovations, and it came out at 2.5 million. On a deal that I'm looking at now, it's a chiller property. Chillers don't scare me as long as we've got money and reserves that um, we're budgeting to make repairs. But naturally, I want to look at it as like, hey, what can we do to convert a chiller property to an individual HVAC? Well, I learned a lot in the last couple of weeks. Like, it's a lot of electrical upgrades, and that electrical upgrades for this particular property was around 600,000. The HVACs were around 500,000, and then you would need about 100,000 for framing and other type of work. So it's over $1.2 million. Well, that kills the deal. But it doesn't kill the deal if you don't do that project. Instead you just budget a new chiller or budget some plumbing. So anyway, long-winded response, but I feel like due diligence and really have an understanding of that capital plan and being conservative in the underwriting are all important things. Jeremy, you and I, this reputation or this industry is based on reputation, and investors know that it's not always going to be perfect. There's going to be ups and downs, but we have to have that integrity in that conversation and the transparency of like, hey, this is what's going on. This is what we're doing to fix it, or this is what we can control, right? There's things that we can't control, but that's something we pride ourselves on at CREI Partners is we're consistently being transparent, providing monthly reports, a full monthly report, not just certain documents. Like they have full transparency of what's going on with the property. And I think that's just an important thing of that trust, and it feeds into the underwriting.
Fantastic. A lot of the listeners here are maybe new to real estate investing and maybe even new to syndications and passive investing. And so they're hearing us talking about on our side as syndicators and general partners of the extensive amount of underwriting and due diligence that we do. And we do that so the passive investor does not have to do all that, take all that time, spend the money, and have the knowledge base to do all that. But all that being said, what do you recommend for passive investors to ask, and what is their due diligence on us as GPs?
Mm-hmm. So I'm not gonna lie, the greatest compliment and trust is I open a deal and they already soft committed $200,000 and we hadn't even really talked. Like that's when like, okay, I've obviously built a strong trust, and they know that if I'm coming out on a deal, that it's something to be part of. I think one thing that from a passive investor is when you're looking at the business plan, none of this is rocket science. None of this is too challenging. And I'm not trying to simplify what we're doing, but I think passive investors, what I tell them, and for our investments too, is does my gut sit right on the assumptions? It's a business plan. Every property is its own business plan. And that's what makes it really great, because as a passive investor, you do not have to invest your money into this business, meaning that property is the business, right? You're looking at an investment opportunity. So you're looking through the PPM and you're looking through the business plan, whether that's a PowerPoint or whatever the deliverable is. And you're seeing, okay, this property is of this age and these are the things that need to be improved. This is the comp area. This is the competition. And think of it more like a SWOT analysis. What's a strength, weakness, opportunity, threat? Think of it just like a business plan, right? People that are investing passively in real estate, high chance that they have some type of business or financial acumen, right? So think of it as it's a business. Do you think rents can grow 10% year over year? Well, maybe they can in year one, maybe, but if the underwriter has it at that over the next 5 years, okay, that's a red flag. Maybe that's something that, like, as a business person, I don't know if my revenues are going to push that long. Maybe that's pushing it up to 10% gets it to market, and then maybe the next year we're seeing some growth. I mean, again, you're trying to just see if it makes sense on the operating expenses. Does it make sense that we're lowering repairs and maintenance by $15,000 compared to what they did? Well, Jeremy, maybe it does if we're spending $2 million. Like I said, we replaced the HVACs, we did the roofs, we're doing some plumbing. Okay, well, we're doing some capital improvements, we're renovating, repositioning the property. So yeah, maybe it does make sense on that. But if you're not doing that, then okay, that could be a red flag. So there's just those red flags. I would just say, ask questions about the business plan, because that's what it is. It's a business. The other thing is don't be more tied up with a person. I see a lot of traffic on Facebook and social media about, how much that person invests in the deal or the experience. I'm not as worried about that, because the amount of sweat equity and the work that goes into this and the risk that goes, like we put sometimes 6 figures down on 100,000 into an earnest account. Well, that's risk money. And so you want your sponsor to be liquid in some form of the fashion. But what's more important to me is the team, right? I love the hungry new guys that are just like, they really want to make a name for themselves and they want to do things right. That's great. Now I want to see that supported by a strong team of people that have gone through multiple exits and who have a strong track record, right? So that's really important. How quickly do they respond back to your emails? Are they on social media? Are they active? Um, and you're trusting that this jockey is going to be around for the next 5 to 6 years.
Yeah.
So you want to know that, like, hey, they are truly invested in what they're doing, and this is not um, a few months or a year or two excitement, and then they get bored with it, because it's a lot of work, Jeremy. Like, this, like the asset management piece and the grind of the work. I mean, we did over 20 evictions at this property I was telling you about, over 20 evictions, and we're still evicting some people. We're cleaning house. And it's not because these people, we want to raise rents and get them out. These are people that shouldn't have been there in the first place. Like, these are uh, not the best people that you would want to be around kids or your family. So um, anyway, so hopefully that helps a little bit. There's a lot of ebooks and stuff out there that have like 100 questions to ask. The reality, Jeremy, is that sponsors don't always have time to answer 100 questions, right? So you want to meet and feel like you're educated enough prior to that investment opportunity to make a decision as a sophisticated investor. And if you can do that, then great. If not, if you feel like your learning process starts when you get that opportunity, I would suggest hold off, get educated, join a passive investor course, join a mentorship group, or go to a meetup, read books. There's a lot of free things. Listen to your podcast. There are a lot of things that people can do to educate themselves, so that when that opportunity comes, they feel confident in how they look at it.
Yeah, that's excellent advice. I'm a passive investor in many real estate deals myself, and um, I I am more towards what you started out, the answering that question of a deal comes, I already know the partner, and I'm already signing the subscription docs, and I'm already wiring the money. Like that's where I'm at already, because it's the trust, their track record, and I know their previous deals. On the other hand, though, if I had a friend or relative that said, "Hey, Jeremy, I'm in real estate syndication now, and I found this great deal. Come partner with me," and I'd say, "Well, okay, I know your background. You haven't invested anything. Let me look at the deal. Let me underwrite. Let me ask these tough questions." So yeah, it's based on the track record, their experience as well.
Yeah. Yeah. And if anyone's looking at investing, so I had this one investor. He's not an investor. He hasn't invested in our deals. I actually looked at a deal and sort of blessed it. Went through the things that you're talking about. Going through the process to see if it works. And so I invested in that deal. But he messaged me one day. And he said, "I feel like I'm missing out on the next deal." And my thing is like, you're not missing out. Like, there are always going to be deals, good times, bad times. I always feel like there are going to be deals to be made. The best thing to do is just, one, most people, Jeremy, are herd mentality, stock market, 401k, and that's great. I have stocks and I enjoy I enjoy buying stocks. I enjoy looking at, like, for me, it's that's an enjoyable part of investing, right? And there's things that I view it as like Vegas money. I'm like, okay, I'm gonna put money into the more, you know, high risk, so think of it like this should be a fun experience. Investing doesn't always have to be so serious and, like, scary. You're not going to miss.
Yeah, I'll interrupt you. That's kind of where I was wanting to go. Is that's exactly how I feel about stocks, and I think a lot of people have that same. Some people don't even think about stocks because it's in they have their 401k, and it's just they don't even think at all. It's just automatic from their employer going in their 401k. So they don't even think about it. So that's one type of person. The other type of person is like you and me. It's like it's Vegas money. It's just kind of, oh, hopefully we hope, I hope it's hope based investing. I think I had one of our raise masters, TJ Visiode. He said that. He said it's hope based investing. I like that. But
Yeah.
You're just hoping, you're gambling that the stock will go up or go down. But now when people start thinking of real estate syndication, all of a sudden a lot of people, they get in this over analytical mindset of trying to tear apart your deal. And you're like, well, you weren't even looking at your 401k. You got 6 figures, 7 figures in there. You don't even look at it. And now you're trying to analyze whether or not you're going to spend $50,000 on my deal. So it's kind of hypocritical in some way.
A little bit, and you're right, because if you think about it, stocks, you're a passive investor as well, and you really, you're trusting that the executive and the board members and the team, the team are all aligned and working towards the business plan, right? Now, it's diversification. As we get into a recession time, if there, nobody knows if we're going to go in a deep recession, a soft recession, or whatever. Again, I don't really time the markets. I'm one of those consistent dollar average type investor, but I also like, hey, I remember in 2007 when I joined the company I still work for, with my W-2 job. It's a commercial 125 company, and so, but I remember I didn't have any money. Like 2007, I was right out of the Marine Corps, but that was about the time 2008, 2009 when things started tanking, and I remember our stock in the company went down to like $2, and like there was all these stocks just came really low, but I didn't have any money to invest. But now that I have disposable income to invest, I'm like, well, what did I learn from 2008, 2009? What industries, what do people really need during when times are tough? And times are tough. Like Jeremy, I feel, I feel very blessed, and I feel like I'm in a bubble. But I was at a property that we own early this week, and I went to a Subway, and I ordered my food. I don't even think about the money. I know what I want. I want a foot long Italian herb and cheese. And this gentleman came in behind me, and he's like, "What can I?" And he asked. He was very nice. He was like, what can I get for $5?" And then he's looking. I may tear up. He's like looking like what meat. He's asking. Can I get the turkey? Can I get the ham? And I am. I just went to a property that we own that's over $12 million, and that we're doing okay on. And then this gentleman's coming in, and he's like, what can I get? And it felt good buying. He didn't know I bought his dinner. I was like, I'll buy it, and I left. But the point is like not everybody is in a good position, right? So that's like maybe like an extreme example, but there's other examples of like maybe people during recession times aren't going to be shopping at the higher end stores, so they go to the lower end stores, right? And so it goes back to the stocks. What companies, what places do better during recessionary times? So because I experienced that when I didn't have money in 2007 to 2009, I'm trying to remember those time periods to now, and I'm buying more into like Walmart or other industries, still very strong balance sheet companies, but could do better. Home Depot being another example. Like those companies tend to do a little bit better during recessionary times because people are doing more work for themselves around the house. They're not outsourcing. So I don't know how we got on that subject, but ultimately, it's diversification is good. Stocks are a good thing. 401k, do your match. That's a good thing. But when you're ready to invest $50,000 of your hard-earned money, that 50,000, it's part of the business plan of being used. So that money isn't sitting and being liquid somewhere. That money is going to replacing that roof that I talked about earlier, those HVACs. It's going to the business plan, right? And so you've got to be, as a passive investor, willing to put in money and realize that money are soldiers. Every dollar is a soldier, and they're working towards that investment to meet that business plan. And if you can do that and still have the savings, still have some other investments that are more liquid, then it's a really good opportunity. There are great benefits that everyone hears about real estate with the tax and the leverage that you put in $10 million or $15 million and you can get a $30-40 million property. Like there are a lot of benefits, cash flow, depreciation, etc. But going back to that investor, Jeremy, like you're not missing the boat if you don't invest today. In fact, you're on the boat. Like you're learning You're trying to get to that position to where you can do it, and you will get there. And just have fun with the ride. Don't be looking on Facebook and be like, hey, this person's supposedly investing, doing all these things. Like, it doesn't matter. Where are you today,
Yeah.
and
Take
where you
action.
want to get?
Excellent. Taking action. So yeah, I guess some final words for the audience on underwriting and taking action. I guess what you have any final words?
Yeah, I mean, take advantage if real estate investing is what you want to do. And we're talking, Jeremy, we've talked more about the multi-million-dollar properties, but I started off at single family. My first single family was while I was in the Marine Corps. It was a rental. I think I bought it for like $80,000 in 29 Palms, California. Like, real estate investing doesn't have to be these multi-million-dollar deals. It's easier to scale, and there's a lot of more risk uh, uh, aversion through that, and that's a whole other subject. But um, take action, learn, educate. There's a lot of meetups, there's passive investor courses, there's books, there's this podcast, there's a lot of free things and things that you can do to get educated. So when that opportunity does come, you're ready to launch. And as far as underwriting, as a passive investor, the great thing about it, Jeremy, is you don't really need to know too much about underwriting. That's the reason why you're a passive investor. Now, there are certain things, though, as I said earlier, think of it like a business. Don't overcomplicate it. Do the revenues make sense? Do the expenses make sense? Do you have a team that you believe can execute the deal? If those things line out and you feel good about the location, I mentioned websites earlier, and you feel like, hey, this is going to be a good investment, then roll with it, and be proud that you've diversified, and be excited about that. Hey, and if it doesn't work, at the end of the day, it may not be a 50,000 investment. Maybe it's a 20,000. At the end of the day, it's just dollars, and you're learning. It's just like how I learned, the 0809. You're constantly learning and making better decisions to hopefully grow your wealth, but also what really matters is your happiness, right? Um, so hopefully that helps and is valuable to your listeners.
Excellent. Yep. Great advice. All right. So where can the listeners learn more about Wayne, and where can they find you?
So best place is go to CREIpartners.com. On that website, we've got podcast resources. There's a way to connect with me directly through there. We have an ebook. We're really big on education. We do a monthly meetup the fourth Monday of each month. It's the Texas Multifamily Passive and Active Investor course. I'll give you that link that you can put in the thing. But CREIpartners.com would be the best way that you can learn more about us and what we're doing, and hopefully, being of value to your listeners.
Excellent. Well, thank you so much, Wayne, for coming on this podcast. And that's the same vision that we have also, is really educating the people and our listeners out there on how to grow, build, and sustain their wealth. So that's a wrap for this episode of the Wealth Building Strategies Podcast.
Thanks, Jeremy.